Hello, family. Hello, folks. Hello, friends. You're once again welcome back to my channel. Today, I'm here to give you a live and a quick update on volatility 100. Just a few days ago, I posted an update on what we should expect the price to be doing on the market, and beautifully, it played out just as I mentioned on this chart and in the previous video. So you can quickly go back and check out the previous video, what I said about the kind of analysis you should look out for, and the premise you should base your trades on, and all that. For most of you who have been on my channel for quite a couple of time, so I give you live updates, tell you what the market is likely going to do in a day or two, and if you're on the market when it happens, you are able to execute the trade. All right, so we are on volatility 100. For those of you who have been on the market and you have almost given up trading, and they are almost tired of this losing and gaining, and look, I'm here to encourage you that keep on. For those of you who have also been trading for quite a number of years and you're still not seeing any form of gains, I'll encourage you that keep on. Okay, there's time for everything, and one thing that I would encourage you to learn to do is learn to be patient. Okay, all right, now let's jump to the video, and then we are quick with it and we are out of here. All right, so this is volatility 100 synthetic index. All right, so currently this is a monthly time frame, and the market is really panning out well, nicely. There's not a lot of ambiguity and a lot of obstructions happening on the market currently. So we have a clear-cut path that if you are trading this asset pairs, you are likely going to be in the good books if you are going to really use good analysis and follow my videos, as I stick with my ICT concepts, as I stick with my inner cycle trading style. If you haven't been on the chart for quite some time, you realize that everything that I say based on ICT strategy, it just happens. ICT always makes us understand that there is an algorithm behind the market, and funny enough, well, ICT is not trading volatility synthetic indices, but then his analysis on this asset base is gold, is diamond. It's just awesome. So I'm going to take you through briefly, then we will call it a day, or we'll look at other asset pairs for the time being. All right, so quickly, last time when we went to the chart 2 days ago, I told you that we've seen some form of consolidation in here, seen market breakdown, swept the liquidity resting below this low in here. There's this low resting in here, liquidity resting in here has been taken by these price actions. Market traded below it, so all this action beneath it here were to sweep the low resting in here. This is a sell side liquidity that was resting beneath this price. Okay, so at this point, when you look at the price point, the lower point is 1479.70. so all the price that was resting, all the sell orders that were resting beneath this price action or this price point were swept from this side, and you could see that on the higher time frame you are seeing something more like a turtle soup setup, kind of, right? So it was a quick delve into, then we could see the rejection back up into the sky. Okay, so as we've taken the liquidity resting below this sell side, what are we seeking for? we are seeking to um, grab the liquidity resting above these relative equal highs in here. This is my target. All right, this is my ultimate target, and then we'll see what price presents to us. But clearly you could see that there is there's an imbalance right in here, but this is a long-term goal. Now currently this is our ultimate target. Okay, now let me put a line in here for you to be aware of what we are seeking to accomplish at the end of the day. All right, now let's go down to our daily time frame, and I will see how the market played. As I said, so we saw that as market dipped down into this sell side liquidity resting beneath here. Let me put my line in here, so we could see that the sell side liquidity here was grabbed, okay, right here. And then on the daily time frame, we could see that price actually began trading downwards, okay, or price was trending downwards, okay. It traded down to seek the sell side liquidity resting beneath that price action, and then beautifully price bounces back. As it delved deeper into that area, it bounced back. So we had price ranging from this high to this low, to this high to this low. Sometimes on the market, what are some of the things? I'm going to give you some gist, and this is not anything new. These are things that my mentor has mentioned in a couple of his videos. Okay, so let me show you. You may easily not hear him say some of these things, so but I happen to chance upon them and then bring them to your attention. All right, so now you could see that this gap in here, or this imbalance in here, anytime we have a swing high, a swing low, and price trades back to in this imbalance, and then it rejects back down, okay, forming this low resting in here. Anytime we have price doing this, you realize that these are a clear sign of price trading or ranging or selling, trading downwards, ranging downwards, or selling. Okay, so we have a swing. This is a proper swing high because it took down an imbalance. Okay, it went to correct an imbalance, and then it traded down all the way to this low. Look at this high in here. This is a correct high because it came to rebalance the price action here, and then it came down to take this low. Okay, so beautifully we can see price traded up above this correct high in here, and then we had this swing high. So ultimately we would say that we'll consider this high, and then price trades back down, goes up, but we would disregard this high in here and consider this as the high. Okay, because this price action in here was too quick for us. All right, it was just a stop hunt or grab for liquidity. Okay, so we could take this high, this low, all the way to this high, and then price came back down again into this low and into this imbalance in here, rebalanced it totally before we could see the swing higher. All right, so this swing is the swing that we regard as the major swing that was used to take down this high, ultimately causing what we call a market structure shift. Okay, we have a high, a low, a high, a low, and then we have a higher high, okay, taking down this high in here, and then we have a structure shift. As we have the structure shift, what we necessarily expect was price to trade down into an area of interest. Okay, now somebody may ask, so why do you think price should trade all the way to this area before we rebalance, before we go up? Okay, so now let me show you one beautiful thing you should know when it comes to price actions that are more effective and more efficient. Okay, let me show you one. Anytime we have a shift in market structure, all right, so let me be brief with this. Anytime we have a shift in market structure, okay, so for instance, we had this high in here, price trades Oh, sorry, I'm using the wrong tool. All right. So we have price trading all the way down here. It goes up into this high. Okay. Now, this low that has been formed here, okay, will be regarded as a short-term low. Insofar as we see price come down to sweep this low, just a dip into this low, okay, then this one is regarded as a short-term low. So far as we have a market structure shift, okay, we have the structure shift in here, and then it comes back down. So this is a setup just to even take. So for instance, if you saw this area as a market, this high as a market structure shift, and then price trades down back into this area, you execute a trade here, price begins to go back up. You, in your mind, you may think that this is the reversal, so you may think that price should reverse from here and then keep going. You take trade here, you put your stop here. As price goes above, trades above this high, all you do is that you move your stop to this side, and then price comes back to wipe away your stop, and that ends your life. All right, but beautifully, these are short-term lows. Okay, so now watch this. Price comes down back into this, and then what does it do? It sweeps this low. Now this low is regarded as high resistance liquidity. Okay, it's a high resistance liquidity, and then when price takes a high resistance liquidity just into an order block, just also after we have a market structure shift, you should know that we are going to have a very serious run up. Okay, so all the time, take notice, anytime we have a structure shift and then there is this incident happening, okay, you find a short-term low that has been formed before or into the order block, we want price to necessarily come down to sweep this short-term low. Okay, then we want to have a rally back up. This is what usually forms what we call a solid order blocks. Okay, this is what gives rise to, usually high resistance liquidity runs are what usually give rise to high solid or highly accepted or highly confident order blocks. Okay, so now watch this. There was this low in here. Okay, there was this low in here. That price actually traded down and took this low. All right, so as price took this low resting in here, all right, as price took this low resting in here, and then it rallies back up above this high, it makes this low a high resistance liquidity. Okay, this is it, high resistance liquidity. So price runs or rally up. So when price came down in here, see, after it took down this high resistance liquidity, what did it target? The low resistance liquidity. This high, this high, this high. These are low resistance liquidity, which was more like a trend. Okay, regard it as low resistance liquidity. You get it exactly. So price rallies to take down all this low resistance liquidity so easily. When price is taking down low resistance liquidity, it rallies quickly and so easily. All right. Now let's look at what I was just describing here. So price takes down this low resistance liquidity, and then it rallies back up into the sky. Take down the previous high that was formed. Now automatically we have a proper swing high that has been formed again. Now let me go back and give you more clearer picture. Okay, now watch this. We have a swing from this point to this high. Where do you necessarily think that price should reverse before it begins to shoot up? In my previous video, I was trying to explain to you where I was going to expect price to reverse. And when we saw this happening, I told you that price could necessarily come down into this area. Your price had already come down into this area, and then it was trading upwards. So I was expecting price to come fill this fair value gap resting in here, and then we wanted to see price rally back up. And beautifully, you saw price traded back down, and then it filled this fair value gap, and then we see the rally up. Now, where would you necessarily think that price should reverse into? For instance, if we are taking this swing low to this swing high, we are always looking at price giving us 50% off. So when we have, if you understand what we mean by premium and discount prices, this is where it comes into play. If you don't understand what it means to say that price is in premium or price is in discount, go back to my old videos and I'm sure you are going to get detailed information on that. Now watch this. So when we say premium prices, when I pull this fib from this point to this, from this high to this low, from this high to this low, you realize that from this swing we have 50% of it, which is just inside this line resting in here. Okay, so this is a first part, this is a first lower part, and then the second lower and second lower, and then we have these two middle, then 50% being where this green line is. Okay, so the upper part, the upper 50 part is what we call premium, and the lower 50 part is what we call discount. Okay, so these are discount prices. Any price below this area is regarded as discount price. Prices above this area is regarded as premium prices. Now the market is in such a way that the market makers would want to buy at discount prices. I hope you understand what I'm trying to insinuate here. The market makers would, or the algorithm would want to buy at more discount prices. So when price comes down into discount, this is where, if there's a swing, okay, what we call dealing range, if we have a dealing range or a swing from this low to this high, when we have price retracing, okay, when we have price retracing, we want to see price or the buying action taking place in discount areas, okay, or discounted prices. Discounted prices, you would understand that, I mean, prices are lower, so they are able to buy more from this point. Okay, and then when price, the inverse is when we have price swinging from a high to a low. Okay, when we have a market that is a bearish market, okay, we want to seek for price to be selling more at premium prices. So we sell more at premium prices when we are in a bearish market. But in this situation, we are in a bullish market situation, okay, where we have swing lows and we have lower lows, and then we have higher highs. Okay, so we are in a bullish market situation. Now we want to seek for buy orders in discount prices. Discount is when price falls below 50%. Okay, when it falls below the 50%, now you begin to hunt for where is price going to reverse. Beautifully, when price fell below this 50% line, you realize that on a smaller time frame you may find price doing a reversal in here. Okay, so when you go down to your 15, 20, 1 hour time frame, you'll find something beautiful. So let's look at this on a 1 hour time frame. Okay, let's look at this on a 1 hour time frame. Good. Where were we looking at? Okay, so we're looking at this particular price action in here. Now watch this. You saw this price form this low from this high. It came down all the way to form this low, this high, this low, came up here. Why am I disregarding this? This is an accumulation. Okay, when you look at it well, you realize that price was accumulating all this. Okay, so it doesn't form any high, neither is it forming any low in here. Okay, so we look at the market well, especially when you're looking at certain time frames, especially on the 1 hour time frame. Okay, so market was accumulating orders here before it continued downwards. All right, then we saw this manipulation leg up. Then so when market accumulated orders, we had the swing lower, and then we have price manipulating to sweep liquidity above it. So you watch this. I'll teach you one thing about this particular form of setup, where we have accumulation, price sweeps below the accumulation, it goes above the accumulation. So we have something of the sort. Lower, higher, taking down all the liquidity, resting above the buy side liquidity, above it the sell side liquidity has been taken. Okay, so we have this, and then we have the swing breaking down to continue the pattern. All right, now on the 1 hour time frame, where did we see the reversal happening? So you watch this. Price took the high of this swing in here, right in here, this particular candle or this particular price action took down the high resting in here. Then we saw the reversal. Okay, the reversal came back in here already because price was, let me show you, this was an order block. It has taken a high resistance liquidity already. This forms an order block. Price rallies back up, comes down into this order block. So this one forms an order block. This particular continuous candle forms an order block. Price rallies back up. Look at this bearish candle closing. Okay, so let me zoom in. So look at this bearish candle closing in on this. So this forms a very solid order block. Price rallies back away from this order block. Okay, you see how they are all seated in the candle, in this bearish candle in here, this order block, and then it rallies back up. Price straight back into this order block. Now we have what we call proportion block. First order block, second order block. Now we have a third order block into this particular order block. So two of them. Now realize that price straight back into this order blocks. Okay, and then what we see price rally away. So in as much as we had the high taken in here on the 1 hour time frame, yes, there was some form of reversal, but here we weren't expecting price to come into 50% of this range from this low to this high. It's not all the time we expect it to do that, especially when we have a couple of proportion blocks being formed, okay, in the form of like an accumulation, one other block after the other. We don't really expect the price to come down. There is no liquidity resting anywhere for it to come and grab. Okay, now let's go back to our daily time frame as we explain it. Okay, so beautifully you could see that price traded below 50%. All right, sometimes you will easily catch it when you have this eye to see, okay, if I take a trade inside a 50% level. Now you can apply this on a smaller time frame. If you are taking a trade, let's say you have a swing and you are taking it inside the 50% level or below the 50% level, you are taking a buy. Now calculate your stop loss to see that, okay, if I'm taking it beneath the 50% level, anywhere inside the 50% level, if I place my stop here, you look at your equity level and you look at your stops, risk management. If it is okay for you, then you execute the trade. You can even place a buy stops in here, okay, so that when the trade trades down, when the market trades down, it triggers for you. All right, now it trades back, we rally up. Now let's go to this particular area we are seeing here, which I talked about, that price was going to come down into this area. Now let's go down to our 4 hour time frame. So in a 4 hour time frame, we saw this fair value gap resting inside of this area. So we were delineating what price was going to do, because there is an imbalance in here. Would price come and rebalance before we see the rally up? Okay, because there was this major swing high in here. This is the swing low and this was the swing high. All right, now, so what happens? I told you that price was going to dip. We got somewhere here, and I told you something. We got somewhere here. I told you something, that either price closes in on this fair value gap resting in here, or it continues up to take this high. Okay, and I told you that especially when we have a bearish candle forming right before, a few pips before the high, when we could see clearly that price is surging higher. Okay, and beautifully price actually did that. So price actually traded into this high before we saw the breakdown. So now watch this. This has been taken as a high resistance liquidity run to rally up to take this high. We have a new high formed. So we have this swing from this high to this low, from this low to this high as a new swing. Okay, now watch this. If we have this swing as our new high and new low, where is the 50% level? This is it. Okay, and where did we see price retracing? So from this high to this, from this low to this high, price retraces back below 50%. So now we are deep into discount. Okay, what do? You can set your trade in here if you see any form of reversal. Now beautifully on the 4 hour time frame, price came down took this low resting in here and dipped further into the fair value gap. Okay, now what does it say? As it has dipped further into this fair value gap, you realize that this is a high resistance liquidity that has been grabbed, and then when price did that, it rallied back up. Now watch this swing. So we have a swing even on the 4-hour time frame. We have this swing low, from this low to this high. Okay, and then we have a lower low, a higher low, and we have a higher high, higher low, higher high. Then we have a breakdown, okay, to form a lower low. Okay, so this is showing a sign of retracement or reversal. Then we have a high has been formed in here. Okay, then we have a lower low which has been formed in here, showing us that we are in a bearish market. Right after this situation, we have a market rallying up. That is when it has taken down this fair value gap, traded below this sell side liquidity resting in here to give rise to a high resistance liquidity run, and then we have a shift in market structure again. So beautifully, what have I told you about when we have a high resistance liquidity run? So that bearish candle which formed this particular swing, which broke, makes a solid order block. So now watch this. When price retraced back into this order block, you realize that price didn't even stay in here, but then it rallied back up. So now if you had caught a trade in around this area, okay, if you have caught a trade in around this area, your stop is below this. And what's the target? The target is this high. Now let's go down to our 15 minutes time frame, or let's say our 1 hour time frame, to even see if we could have caught a clear trade in here. Well, we have this swing low, swing high. Then you could see market has actually shifted structure. It trades back into this order block, okay, which on the 1 hour time frame, I told you it has taken a high resistance liquidity. It has formed a high resistance liquidity run just even before it has done the same. So it's a very high probable order block. Okay, then price trades into it, and then we see a rally back up. How do we even also detect from here to even join a trade in here? Now let's go down to our 15 minute time frame. So on the 15 minutes time frame, see how it played out beautiful in here. See how it played out beautifully in here. So this is where we're looking at. Okay, so we had the market shifting all the way up in here. Now watch this. Swing high, swing low, swing high, swing low. Then we have market coming in here. It didn't break the high in here, but it broke the high right in here. Okay, it broke the high right in here. Then you see a rally back down into what? This market, this continuous order block in here has already, there's no liquidity in here to be grabbed, because this has already taken the fair value gap or the imbalance in here, come up, traded up this way, and has formed an order block in here. So price trades into this order block, and then we see the rally back up. So here is a perfect place that you could have executed a trade. It's as simple as that. And then your stops now even becomes more smaller. You get it? Your stops even becomes more smaller. If you were even afraid for the fact that, oh, if price was reversing in here, it hadn't taken down this high, so you waited, price did it here, and it came down in here, you could have easily joined the market from here, and you see your way all the way up into the sky. So you refine your entry much further on the 15 minutes time frame, but you can see clearly all that was happening on the 4-hour time frame. Clearly, a swing high, a low, a swing high, a low, and then we have a structure shift. Price trades back into this, and then we see a bounce back into. Now the body of the candles tell the story. The wicks, they do the damage. So you could see how this wicked all the way into this particular, the body of this candle even, and then we see the body of the candle closing above or in the wick of this candle, showing a perfect rejection, and then we see price rally back up. Now watch this. As we saw price rallying back up into this side, we're expecting this fair value gap to also be closed, but be it known unto you, there's not all fair value gaps that are to be closed. My next video, I'll take you deeper into what we call gaps. Okay, there are some breakaway gaps, there are some common gaps. I will explain them into details. All right, so these are basically a few things I wanted to bring to your attention or to your notice about what has really transpired on the market. I believe this video, if you take your time and you listen well and you watch, you will glean a lot of information in here, and then probably I'll see you in the next video. Now let me give you what's next. So when we see this swing low that has been formed in here, now this is the perfect low. Where are we expecting price to head next? So this swing has been completed. We have this swing low. Now price is forming another higher high until we see some form of reversal back. I'm looking at this area as a target, this relative equal lows as a target. Price can equally dip below this sell side liquidities resting in here, losing on this fair value gap, and then I can see price going back up again. Right, should price reverse from where it is currently and not continue to form another high, it can do what I just mentioned, that it can close below this relative equal lows, take this sell side liquidity resting in here, and then now this also becomes an order block, in the sense that it traded into this order block and then it rallied price up. So this becomes an order block. Should price come back into this area, you can frame a trade around this area. Okay, now let's see if price takes this swing as it high and takes this area as it high, and then the low in here. Where is the 50%? The 50% is inside this area. Okay, so any price below this 50% level is regarded as a discount price, and we buy in discount. So anything below this, we want to seek to frame our buys around this area, and then we'll look at placing our stops below this. Okay, so beautifully, this is what I'm expecting. So if you see price rally back down, take the sell side liquidity resting in here, it rally up, and it shows you a sign that it has reversed back up, you should know that a high resistance liquidity has been formed, and from whichever other block that has been formed after this, and you see the pattern changed or the shift, the market structure shift, you obviously have a go ahead to enter a trade. All right, so this video is basically for education purpose and not an investment advice. All right, I wish you all the best in your trading. If you are new to my channel, please do well and subscribe. If you are an old customer, if you are old friend, if you are old folk, you always smash the like button, and I'll see you in the next video. I wish you all the best. Do have the best of the night. See you.